Learning objective number 3. List the steps of the transaction recording process. Okay, so let's go to full screen for this objective, shall we? So, the journalizing process. What we do with a transaction is we identify each account affected and its type. Okay, so if we're purchasing supplies for cash, we would identify supplies and cash and identify its type. They're both asset accounts. We determine, number 2, if each account is increased or decreased. If we're purchasing supplies, supplies is being increased. Paying cash, we will decrease it. And then you would apply the rules of debit and credit to record the transaction in the journal. Now, a journal entry always has 4 parts. Okay, it's the date of the transaction. Remember, the journal is a chronological record of transactions. So we have the date, we have the title of the account being debited with a dollar amount, we have a title of the account being credited with a dollar amount, and a brief explanation of the transaction. So those are the 4 parts. The date, the account being debited, the account being credited, and a brief explanation of the transaction. Always with a journal entry. So, looking at this sample journal entry, on July the 1st, Josie Smith invested $45,000 of cash. Cash is increasing. Josie Smith capital is increasing. We increase cash with a debit for $45,000. We increase Josie Smith capital, which is an owner's equity account, for $45,000. And of course, the explanation down here would be owner investment. So date, the account being debited, the account being credited, and the explanation, just as we noted on the last slide. You'll also note that credits are always indented, approximately 5, 6 spaces. What this is, it's a visual aid for the accountant to recognize that this account is being credited. You'll also notice that debit on the left, credit on the right. We've got the transaction date, the accounts affected, the dollar amounts of the debits and credits, and our brief explanation of the transaction. Posting is simply copying the amounts from the journal, right here, into the ledger accounts. Okay, so posting is just copying the transaction from the journal to the ledger. Okay? So, let's look at short exercise 2-6 on page 93 of your text. 2-6, page 93 of your text. Journalizing transactions. As I said in our last chapter, what we do is go first to the requirement to understand what we need to look for in the problem. This is a very time-saving step. Lakeview sales consultant completed the following transactions during the later part of March. They want us to journalize the transactions of Lakeview sales consultants, including an explanation with each journal entry. On March the 22nd, we performed services for customers on account $4,000. Okay? So, we know that we're performing a service for customers, but in the narrative it says on account. So that means we're not receiving the cash, we're extending our credit to the customers. So on account, we would say, indicates an accounts receivable. Accounts receivable is an asset account. We increase an asset with a debit for $4,000. Okay, we perform services. So what we do is we're going to record an increase to revenue because services has been performed. To increase a revenue account under the rules of debit and credit, specifically clerk, credits increase revenues by $4,000. And of course, again, we've got our brief explanation. Performed services on account. Going back to the problem, on March 30th we received cash on account from a customer, $3,000. Okay, so cash is received. We increase cash, an asset, with a debit for $3,000. Okay, we're receiving it from customers on account. So a customer is paying their bill. Remember, we extended them credit. So the payment on account, we're going to decrease the accounts receivable with a credit. And of course, the explanation would be we received payment on account. On the 31st, we received a utility bill for $130, which will be paid during April. Okay, so on March the 31st, we're going to record the utility expense. Okay, the expense is increased with a debit for $130, and we will credit accounts payable because we're going to pay it at a later date. We increase a liability with a credit. Since we're paying this at a later date, we would credit accounts payable. We increase an accounts payable with a credit for $130. Now you're going to ask yourself, well, wait a minute. What if we paid it with cash today? Instead of crediting the accounts payable, we would credit the cash for $130. Since we're paying it later, we're creating the account payable. On March the 31st, we paid monthly salary to the salesman, $2,300. Salaries to an employee are an expense. We increase an expense with a debit. The salary was paid in cash, so we'll credit the cash. We're paying out the cash. When we pay out cash, that's a credit. Assets are decreased by a credit. We paid salaries. On March the 31st, we paid advertising expense of $400. Okay, on March the 31st, we paid advertising of $400. We're going to debit the advertising expense, since it's increasing, by $400, and we're going to credit cash because we paid cash. If you look at the narrative, it says paid. So when you see the word paid, it means cash is decreasing. Debit the advertising expense, credit the cash. We paid advertising. A source document. A source document is the origin of accounting transactions. And examples of source document might be bills, bank deposit tickets, invoices, checks, stock certificates. So source documents are very important for recording transactions in the accounting process.